Wait for the kookaburras. So over the past quarter, we've seen markets enjoy a decent dose of relief. The previous quarter was somewhat stressful. Many people have referred to it as a crisis, and we certainly saw that sort of activity, that sort of fearful behaviour over the prior quarter. So as fiscal and monetary authorities stepped up to the plate, and as the initial panic of what was going on with COVID-19 started to subside, we saw over the quarter some pretty steady gains. So across asset classes, we've seen pretty much what we'd expect over the quarter as investors have become a little bit more relaxed about the unfolding situation. So ultimately what we've seen the asset classes that have sold off the most heavily, broadly being the ones that have benefited the most over these past couple of months. Interestingly, when we look at the US stock market has done the best, and in fact the tech-heavy NASDAQ is now at all-time highs. So there have clearly been some winners from what we've been going through. So what we're facing is an economic crisis that was born from a health crisis by way of lockdown. So ultimately, every time we have to lock down, every time we have a re-emergence of the virus, it's going to damage our economies. I think there's a real question as to whether any of these really count as a true second wave. I think if you speak to someone in the medical profession, they'll have a clear definition of what constitutes a second wave and what constitutes just a rebound in a first wave. But ultimately, the key importance for economies to be able to rebound is that connections between economic agents, so we're talking about employees and businesses, we're talking about suppliers and companies, that structure needs to remain in place. And every time we shut down, a bit of damage is done. So when we think of those relationships and those connections, we're thinking about, the Job Keeper program is really in place to try and protect the connection between workers and their employers. And so ultimately, we're expecting to see more waves or more emergences of the virus, because without a vaccine, it's not going to go away, and that will cause problems. But that is exactly what we're baking into our forward thinking. So the RBA ultimately lowers interest rates to support the economy. So the fact that we are at the lowest bound that we can really be before going to zero or negative interest rates really shows us that the RBA is concerned about the economy. The good news is that they are paying attention and that they are doing things about it. So whilst they've made it very clear that they are unlikely to follow Europe and run a negative interest rate policy, what they are doing is using some newer tools. So yield curve monitoring and management out to 3 years and a few other things. So the RBA is taking extensive measures really to support and encourage a recovery. So the Australian dollar internationally is deemed to be a risk currency. So what that really means is in times of hardship or in times of stress, the Australian dollar ultimately weakens. Now, add to that, when we look at the Australian dollar, most of the time we're thinking of it in US dollar terms. The US dollar is known to be a safe haven currency. So in tough times, we see the Australian dollar weaken and the US dollar strengthen. And that's exactly what we saw. And then this past quarter, we saw a reversion of those factors. So ultimately we saw the safe haven desire, the safe haven demand for the dollar reduce, and the fear around the Australian dollar reduce as well, and that's led to a strengthening case. Over the coming months, with the Australian dollar in US dollar terms just below long-term averages, we probably see some room for upside. But of course, with new economic information due to come, over the coming months and weeks, it's really important to monitor those points, because a small amount of information can really change the outlook at the moment. One could certainly say that alternatives have had a difficult quarter, and we've seen that. We've certainly seen some of the big names in the hedge fund world shutting up shop or retreating back to what's known as a family office. But ultimately, the way we at Perpetual Private look at alternatives is different to the broad market. And when I say that, what we're not looking for is these high-flying hedge funds where you're paying ridiculously high fees, and ultimately you're not getting much diversification benefits. Quite regularly, these hedge funds that have got sort of brand names on them tend to do well when times are good, but they really tend to do poorly when things get a bit more challenging. So the way we consider alternatives is we're really looking at capturing investment returns that are uncorrelated, not negatively correlated, but uncorrelated from other asset classes, because that then gives us a smoothness to long-term returns. So when I think about the growth opportunities and the income opportunities funds, both of them have broadly performed as we would have hoped. The current markets have seen some markdowns in the valuations of the assets that we're holding within those strategies, but that's really done in reference to the public markets. So, as we've had no impairments within the funds, we're actually expecting that valuation caution to release over time and those capital values to very quickly return. This environment has brought up a lot of opportunities, which is great because they're opportunities funds. Investment markets are still going to have to reconcile this issue of economic damage being caused and then trying to balance that off against the support that's been put in place by authorities. And over the coming months, as the data comes through, we're going to adjust to that. So at the moment, it's really hard to know. Certainly, we expect markets to experience volatility over the coming months, particularly with the US in an election year. So the presidential election in the US is November this year, and as President Trump's not going to be able to go out with a strong economy, it's pretty clear that he's going to try and appear to be a wartime president. And really what that means is aggressive geopolitics. So we've seen a lot of saber rattling with China, and we're expecting more of that to continue. We wouldn't even be surprised if we see Iran start to come to the front pages again either. I think the current environment is a great reminder that markets are uncertain, and that when you're looking at long-term plans, it really is the long term you're thinking of. All too often when we've seen long periods of market expansion, we have investors come to us asking to effectively increase risk levels just so that they can chase higher returns. That's not a good long-term planning process, and it generally ends with bad outcomes. So for most people who, as you're approaching retirement age, you really should be gradually de-risking your portfolio. The last thing you want to do is have a crisis right in your final year before retirement. Really set your plans to waste. But the key thing is, and when we look across studies of investor behavior, is not to panic. When we look at damage done to long-term return profiles for investors, it tends to be done by overreacting, by panicking and selling at the bottom, and then finally giving in and buying back at the top. So, seek advice, don't do anything in a panic, and really consider what your long-term goals for investment are. Yeah, look, I won't say I don't miss being in the office. I never thought I'd say that, but I definitely miss being in the office and being, physically proximate to my colleagues. But the great thing is, I guess having spent a life in financial markets, we've actually been able to very quickly adapt to the new environment. This is the home that I grew up in, so I've come out here to look after my elderly parents whilst we're going through this crisis, and it's not too bad.